videos and later courses, I'll discuss more complex revenue recognition considerations. So let's dive straight into it. So cash sales for services performed. Between December 1st, 2019 and December 31st, 2019, Coombs Inc. provided and completed $5,000 in consulting services that were charged on a time and materials basis. That means that the company is providing consulting services and billing those services for the times, the hours put in. That's what times and materials, or T and M, those letters, basis means. Coombs Inc. received cash for all of these services in by December 31st, 2019. And so let's say I'm the consultant of Coombs Inc. I'm performing these services and I billed for these services before the end of the year. So the question is, what are the journal entries for this simple revenue recognition consideration? And the key here is that we're debiting cash, we've received cash, and we're crediting sales, sales being revenue recognized. Right now, cash basis revenue for this transaction and accrual basis revenue are going to be the same because we have received cash for all the revenue we've recognized to date. So next step is we do a TAccount just to make sure our debits equal our credits. And so cash is an asset, it's a current asset. Assets have a normal balance of a debit, and then our credits are revenue. So our revenue is our sales or our consulting sales. Revenue has a normal balance of a credit, and we both have them at $5,000. So our TAccount balances, and we're okay to move on to the next step. Again, this is the first step, and rule of accounting is debits always have to equal credits. The next step is our income statement and our accounting equation, the accounting equation being the balance sheet. So our income statement now would show our revenues of $5,000. Previously we had no revenues, and our costs and expenses are only G&A or general and administrative so far, for a net income of $4,450. This then flows into our statement of shareholders' equity, which adjusts our retained earnings. Right, so our retained earnings, if you watched our previous video, was decreased by things like depreciation and our prepaid amortization. Now we've increased it, and now we have a net income. So this goes from net loss to net income. It's $4,450, which increases our overall equity on our balance sheet. So we're always preparing these financial statements in this order, right? We're going to prepare that income statement, then we're going to prepare our statement of shareholders' equity, or in earlier accounting courses you might call this statement of retained earnings. And then we go into our balance sheet. So our balance sheet, we're going to make sure that these tie, the 14,450 and the 14,450 tie, and we're going to break in the assets. So assets, now we have 10,200. That was just the $5,000 increase in cash from the previous video. We have our prepaid rent and our net equipment of $1,750. We have no liabilities yet for our company, and our equity is our common stock, our APIC, and our retained earnings, right? This retained earnings comes from our statement of shareholders' equity. If you add all of these together, you get your $14,450. And so the question here is, do assets equal liabilities and equity? Yes, they do, and we know our debits equal our credits. So the two fundamental rules of accounting are satisfied. Debits equal credits, and assets equal liabilities plus equity, which is the balance sheet. In future videos, I'm going to be breaking out the balance sheet in more of a actual presentation format, but this is just simplified for the first few videos. So remember, what we have is equal to what we owe and what we own. And so what we have is cash, prepaid rent, and net equipment. We have cash for the business, access to use an office, and equipment. And how have we funded it? We funded it through what we own. What do we own? We own stock from stock that was issued, so there's ownership in our business, and there's retained earnings. So we financed our business through investment from an owner, as well as our operations, the operations being our retained earning, which is our flow from the income statement. Lastly, we have our statement of cash flows. Well, we're using the indirect method for these videos. I'll go into another video where we use the direct method. And I have another video that you can watch that goes into the statement of cash flows in more detail if you need a background here. So how does this transaction impact our statement of cash flows? It's just going to impact our net income here. So our net income now has changed, and so we can see that now we have a net cash provided by operating activities of $2,000. Well, previously we had a loss, or we had an outflow of operating activities because our income was negative, or we had a net loss. So that's the main change here, is this net income. There's not going to be any other adjustments here because there's no balance sheet real impact here. Our cash increased, which is our ending cash, we can see here, but we're not going to have operating, investing, or financing activities because the balance sheet, we had no impact other than that ending cash. And so make sure you watch the previous videos and watch this change of the statement of cash flow so you can understand how it changes from each transaction. If we're not having accounts receivable or deferred revenue change, that's current assets, current liabilities, operating activities aren't going to change. We didn't buy a long-term asset and we didn't have a long-term liability or have equity changes, so we're not going to have investing or financing activities. So that's it for this video. In our next video, we're going to discuss cash sales of services not performed or deferred revenue. And so this is going to be rather interesting. Deferred revenue is a complex subject, especially now with ASC 606 and contract liabilities. So I'm looking forward to you sticking around. If you have any questions, feel free to ask in the comment box below. And thanks for watching this. Please subscribe and have a great day. Bye.